capital gains tax round 2. Now, importantly, these changes apply to all assets, so make sure you check with your accountant. And secondly, there is no grandfathering. Okay, what's happening is the tax payable on any gains from 1st of July 2027 needs to be calculated under a different method, and any gains made up until 1st of July 2027 needs to be calculated under the old method, and that's regardless of when you bought the asset or what the asset is. But let's have a look at this example. We're going to assume that you bought a $100,000 share portfolio, okay, 1st of July 2022, and you sold it 10 years later for $259,000. That's a 10% annual growth rate. Now, of course, you need to know what the asset was valued at on 1st of July 2027 so you can calculate your tax effectively, okay? And yes, for you nerds, that's a logarithmic chart. Thank you. Now, the first 5 years, okay? 1st of July 27, it was worth $161,000. So we minus off what we paid for it. That's a $61,000 gain. We get a 50% discount under the old system. Okay, now we're going to have a look at the tax brackets here because we're going to assume this individual has $0 of additional income. So they pay 0% tax on the first $18,200 and they pay 16% on the next $12,300. That's total tax payable of $1,968. But what about these 5 years? This is calculated under the new inflation indexation system. So if our asset was worth $161,000, what is our inflation adjusted capital base? Well, we need to know what our inflation is. Okay, now we've assumed it was 4.5%, 4%, 3%, 2.5%, and 2%. Now, if we times all these together, and these will be available on the ATO website, this will give us total compounded inflation of 17% over these 5 years. And if we multiply that by our value at 1st of July 2027, that's going to give us our inflation adjusted capital base. Now, our sale proceeds minus that is going to be calculated as our real inflation adjusted capital gain. Okay, now basically what they're saying is if our asset was worth $161,000 1st of July 27, well, due to inflation, it should be worth $188,000. So any gain over and above that period should therefore be taxable. And that value is $70,360. And if we use our tax brackets, that would be tax payable of 16% of $14,500 and 30% of $56,130. Because remember, we already had a gain of $30,500 to push us up our tax brackets. But hang on, that fails our 30% minimum tax payable on real capital gains, which is applicable under the new system. So we take our inflation adjusted capital gain, we times it by 30%, we add on $1,968, which is the tax payable for the first 5 years, and that gives us our total tax payable of $23,157, calculated under the two separate systems for an individual with $0 of additional income.